Okay, let's take a look at exercise 11-2. So we have a company that distributes umbrellas. They've been experiencing losses, and here's their monthly contribution format income statement. In an effort to isolate the problem, they want the income statement segmented by geographic market. So here's the information that we're given, and we're asked to prepare a contribution format income statement segmented by geographic market. So it's always start off with our sales. So the only difference is now, instead of taking this income statement here, just that's going to be our totals more or less, we're going to break it out by market. So we're told our sales, so we have our markets South, Central, and North, and we're given our sales 600, 800, and 600 given directly to us. Our variable expenses, we're told what percentage of sales they are. So for South, it's 52% of sales. So you just multiply that out yourselves. 52% of 600,000, 312,000. Central is 30%, and North is 40%. So you use that to get your variable expenses. And when you deduct your variable expense from your sales, you have your contribution margin. So the numbers for the individual segments would add across to give you your total for the company. Then we come down, so here's where the difference lies, because this here, the numbers here for the company are the same. It's just we're also breaking them out into the segments. But for fixed expenses, what we've learned in this chapter is some are traceable and some are common. So traceable, they're broken out here. So the traceable fixed expenses, 320, 530, and 300. You add those across to get the traceable fixed expenses. So from there, for the segments, that's it. You deduct the traceable fixed expenses from the contribution margin to get the segment margin for that area. But as we can see up here, fixed expenses were 1,305,000. We've only accounted for 1,150,000 that were traceable. The remainder are common fixed expenses, not traceable to each one of these segments. So for the segments, it ends here. For the company as a total, you also deduct the common expenses to get your operating income or loss. Then, the company's sales manager believes that sales in the central geographic market could be increased by 15% if monthly advertising is increased by 25,000. Would you recommend that? So, they believe that Central's sales could be increased by 15%. So Central's sales were 800,000. So 15% of that, 120,000. So they believe that the sales could increase by 120,000. How much of that would go to contribution margin? So we multiply it by contribution margin ratio, and that is just the contribution margin divided by sales. So if you take that, you get 70%. So 70% of the increase in sales is 84,000. So that's the incremental contribution margin. That's how much the contribution margin would change based on that increase in sales. So we would increase 84,000. The cost of the advertising is only 25,000. So therefore our income would increase, but because fixed expenses would stay the same. So the theory behind this is, if you increase sales, your variable expenses are also going to increase. So you don't just take this number. Your sales increase, your variable expenses increase. So you have to take the contribution margin ratio. But once you multiply it by the ratio, you determine how much your contribution margin, how much this here would increase. Your contribution margin increases, but your fixed expenses stay the same. So the only difference in the expense would be taking on the additional 25,000. So your contribution margin would increase by 84,000. Your additional expense is 25,000. So therefore the remainder goes to your operating income, which is an increase. So yes, you would take that on because you'd spend $25,000 and you'd increase your income by 84, well, the contribution margin by 84,000, leaving you with an increased income of 59,000.